And then Fred is going to present U.S. Energy Development Corporation's QOZ Fund III, a great example of an oil and gas opportunity, investment opportunity wrapped inside of an OZ fund.
Okay, awesome. Well, everybody, thank you so much for the time, Jimmy. I gotta say, I deal with these things every day, and I felt that 1 to 10, I was probably about a 7.5 on op zones, but I think after spending a couple hours with you guys, I'm probably closer to a 3.5. So, which makes me super interested in your content. So awesome, awesome job. So with that, and I'll give you guys kind of an overview, right? So we're a little bit different in this space. Historically, U.S. Energy, we're a almost 50-year-old oil and gas investment firm. Our initial roots go back to the mid 70s. And that was kind of historical for us, where we've built a brand primarily around tax planning in the energy sector, specifically oil and gas. Over the last few decades, we've grown to become the largest operator in the energy sector. We typically will, in these times, we'll probably deploy about $1 billion of CapEx this year through a host of different styles of vehicles. A lot of that tends to be within the QOZ structure, so we'll kind of hone in on some of that. But in general, I think there's some people there when they see or hear that there's this op zone structure within the energy sector, it's a little bit confusing. Like how, why, structurally, what does that look like? And so I'll try to paint a little bit of that picture. So when we look at the space itself, right, and when we look at the actual op zones that are out there, we also want to give you guys a little bit of a backdrop of us and our balance sheet and some of the more financial picture that you might want to paint. So I'll make sure that these are available for everybody. I think some of these slides are going to be more interesting than others. But long story short, when we go back a couple of years, we were probably in somewhere early 2018. At this point, we were about 5 to 6 years operating in what's known as the Permian Basin, which is the core of West Texas production. It's where all of our joint ventures are operated. So we're a little different in our space itself, that we typically don't operate our own assets. We partner with the largest majors out there. So companies like Shell, Exxon, Devon, Matador, Oxy, these are the operators of our assets. We're basically part of their capital stack, right? So we'll look to invest on a heads-up basis with their projects. And the crazy part, right? So the right side of this screen, and you guys have seen this for at least half of this for a while, where you've got all of these, at this point, about 9,000 or so tracks nationwide, about 19% of the domestic landmass. What a lot of people don't realize, and I'm looking at some of those shaded areas, right? The red and specifically the green, that when the governors of each of these states got to select these areas, in Texas, it's no surprise that West Texas, where the Permian Basin is, where all of kind of the heartbeat of oil and gas production is, the best shale rock we've seen in decades is also an op zone. And so for us, it was kind of a natural fit, because one, we're already operating in these areas. It was natural for us to take the same engine that we've been working with in different fund structures and overlaying a different tax chassis to it. And so operationally, you're getting all the normal things and have come to understand in the QOZ structure, and maybe a few different ones that you haven't seen before. So I'll try to focus on and hone in a little bit on those as well. So I will point out and highlight that we are the biggest believer in everything that we do. Right. So in other words, we're very much a believer in an investor in all of the different projects that we offer. So we don't offer anything that we're not personally aligned with. So from the standpoint of different structures that we do, each year will be a little different, but we're approaching, as of this past year, we put over 100 million of our own free cash flow in the same offerings and the same assets that are in all of our funds. So again, it's not just there's other ones as well, but in general, that's a big part, and especially the op zone. You guys did an awesome job going through the QOZB structure and how to do your own. So we actually just did this. It took us about a 3-year build out, but we just completed a project in the heart of Fort Worth, where our HQ is now an op zone, which gives us all of those forward tax-free benefits over time if our current ownership decides to exit out again after a 10-year period of time. But it's an awesome way, right? We kind of call this the mega Roth, right? This unlimited access bucket to basically tax-free return profiles, which can be a really fun thing to use, assuming that you're working with some capital gains, right? So it's always important to see if the chef is eating his own cooking, but let's also look at how we structure, right? So when one of the reasons we're in this business, and well, the first reason was we were already operating there, right? So one day it's not an op zone, the next day it was. So that led us to a lot of discussions with Grant Thornton, who does our audits, with Baker McKinsey, who issues our tax opinions, right? Just to make sure that this could all work. And once we got through that, we started looking at the traditional QOF structure, right? So what's out there, right? And I don't mean what was out there day one, right? Because if we look back to when the TCJ first came out, these things weren't massively popular, right? QOFs, right? It's not, you didn't have a lot of individuals saying, hey, we're going to go do a cannonball into this new sector. People wanted to see how it shook out, right? Treasury took quite some time, about 18 months to get us final rules and regs. And so it caused pause. But once we got that, and we started to see more product come to the space, right? In traditional real estate. So again, we're just developing real estate below ground instead of above, and we'll get to some of those nuances. But we saw a few things in the sector that I think were bothering individuals. So they were giving them pause, right? And I think we could look at an order of importance. Is one was initially the cash flow, right? There's a few requirements with an op zone, and a big one holding this thing 10 years, which you have to do, right? Not that you can't get out of them, but that's a different discussion. But holding it for 10 years, if you're going to park capital for a decade, right? Investors, if they're going to park capital for a long period of time, they typically want some kind of access to that, right? Via cash flow. And I think in the beginning, and it's starting to get better now, but I think early on, this was kind of a black box, right? You saw ops funds that were going to say, hey, look, we're going to have cash flow. We don't know how much, we don't know when, right? We have to get all these projects done, right? You have to go out and acquire assets and double your basis, get tenants and all of this. And eventually we'll get to that. And what was interesting from our perspective is that in oil and gas and energy, because we qualify in a different way, we don't have to follow the same rules as traditional assets, right? So we qualify through original use and source, right? So we don't have to double our basis, right? And you also are in a unique position in terms of revenue, right? So in terms of bringing this back to the top bullet point of lack of cash flow, in oil and gas, you're generating so much cash flow so fast that it's easy to meet those distribution OZ requirements of earned revenue, right? So you're not waiting. Now, we do have a little bit of a wait. There's about a 6-month window before cash flow gets turned on. But the short answer is that after that, investors are basically taking a cash flow of 6% for the life of the fund. And because it's energy, because it's specific to oil and gas, you also have a few unique tax benefits outside of just op zone going on within the fund, right? So from things like intangible drilling cost and depletion, and we'll get into it, but the cash flow on the way out of this thing ends up being tax-free to investors, right? So you can collect a pretty nice cash flow, especially when you look at 6% tax-free. It gives you a pretty nice yield that helps balance out maybe some other parts of the portfolio. And that was the first. The second was kicking the can on the tax, right? So and maybe not so much a concern today because we're only a year or two out, but going back 5-6 years ago, that was an important point because investors had to properly plan for and disclose how they're going to come up with, they're just deferring that tax, right? So that was a unique part for us because we have so much revenue inside of the fund that's being generated but not being released, that having a special distribution come out just out of cash flow, even at around 24%, which is our target, and doing that in a tax-free manner is a non-issue. It's no factor. And just because of the economics, and I'll walk through those. And then finally, aligning. Am I in areas that I want to be in, right? Will these areas gentrify? The weird thing with these is that the best assets are already located here, right? What gentrifies above ground is irrelevant to the production, the extraction, the cash flow that happens beneath. And I think that was kind of part of the excitement on our side, was to launch something that was maybe not a silver bullet, but that could offset some of the traditional issues that people were finding in the typical op zone structure. So what does this mean for investors, right? If we were just to look at, and I'm looking at the red arrow here, if you put $1 in, what to expect, and I'm just going to give some ranges just to paint a picture, but beyond the 6% cash flow, and that's not paid on a quarterly basis at 1.5% per quarter. They'll also get a one-time special distribution of about 24% that's paid in January 27. That's to handle your deferred tax. So it should squash the tax unless you've got a short-term gain, then maybe not quite. And then also the back end, which is a healthy growth component, right? We should have exits in the 2 to 3x or north area, but we can get into that later. But that's just kind of a caption of the cash flow, right? So when we look at that, the best part of that, and you guys all know this, but the biggest thing that we're trying to achieve is a big year 10 bucket, right? So even though our cash flow is 6, we could probably ratchet that up a bit and pay much more, but we wanted to be protective of those economics and keep as much invested, because we want this asset base to grow, to divest of more over time, when in year 10 your outside basis and fair market value line up and equate, and it allows them to exit fully tax-free at a higher amount. So one piece I will touch on, because this is going to be a little bit different than you're seeing in most structures, right? So when we look at most op zones, let's just say 100,000 for easy math. If you put 100,000 into a traditional op zone, that op zone, or that cap gain, is getting deferred, right? It's getting removed from whatever the current year is and placed into 2026 and due in 27. There's a unique part here for our sector in oil and gas, because we are by law required to discount reserves, discount values. It's just how the SEC works and the finance world works in our space. So whether you're Exxon or a little guy, you've got to discount the net present value of future cash flows. In English terms, it means this: if you put 100,000 as an example, right, in these structures, we will have a value reflected in late 2026 that'll be closer to 60 or 70 cents, right, or 60 or 70 grand. And the reason that's important, it doesn't mean your value went down 30%. It means we can assign a lowered value, because now your tax bill's not on 100, it's on 70 or 60 or whatever, right? And this is all in line and required of us on the tax law side. So there's some interesting parts to this and just how the nuances here work. This here is just showing some of the tax equivalents, right? That yield matters. But what's nice here is that you're getting a lot of tax benefits on the way out, not just on the back end at the very end, right? So as I mentioned before, that 6% net's tax-free to investors, and that is unique to the space because of all those natural deductions. In oil and gas, you typically get a lot of write-offs, ordinary income, cap gains, whatever. You get a lot of deductions, above the line deductions in the space. And structurally within the fund, we're simply just taking them and holding them really captive or in suspense against future cash flow, right? Normally, I would give you a big upfront tax deduction in an oil and gas structured offering. But when you come into an op zone day one, you're zero basis, right? Your outside basis is zero day one. So I can't give you a deduction on a zero. But what we can do is take that 80, 90% write-off, hold it within, so everything on the way out becomes tax-free, right? So even over and above that, you get other components like depletion and whatnot. And we've got some materials to send you guys. The other part is that these are the other, I guess, touching point is this is not our first one. This is our 4th op zone fund. So we currently have this. We'll be closing it in a couple of months. It's by no means as big as the multi-billion-dollar funds that are out there, right? This is a different sector, and it's a different structure. But what I will say is that over time, they've all performed at or better than we thought they would. So from the standpoint of long-term return profile expectations, we've seen all of these outrun the punt coverage by a market amount, which for us is really satisfying, because when we go to investors and if we say, hey, we're going to take $1 and turn it into 2, but if you know behind the scenes on the modeling, you're already tracking a 253, that's exciting. We're still telling them a 2, right? But it's just really nice to see that you're seeing and hitting those kinds of numbers this early in the game. We're only in the maybe 5th or 6th inning of these since we first started to structure them. So they've been really successful on that front. And I will say that in one of the biggest parts in the oil and gas space is we get questions about risk, right? Well, if we complete or develop this asset and there's no production and whatnot, or it's a dry hole, as an example, I will say that these are questions that really haven't been relevant in decades. And it doesn't mean that my company is better, smarter, whatever, but it just means that when you're going into these known proven reserves, right? When you're partnering with some of the biggest majors out there and you're going into what they call proven developed production, right? You've got a lot of what are called offset data points, right? So some of these examples on these slides here are showing a singular asset, and then all of these lines around the side are thousands and thousands of well bores. And we're using that offset data, right, to figure out where we're going to go next. So in English, we've been within about 5% of our type curves. All that means is if we expected X, our production is within 5% of that. So the predictability matters, right? We're in the business of manufacturing cash flow, right? It doesn't mean there's no risk. It just means that the risk profiles aren't what people typically think, right? We're just looking to kind of wash, rinse, repeat over and over, right? So normally these style of assets are meant to take a dollar in, give you a lot of tax benefits, and cash flow out very quickly. And then really over time, deplete down. You have this long tail of annuitized cash flow. That's a normal oil and gas occurrence. But with this structure, basically what we did was we just limited the cash flow, right? We basically said instead of paying out 30, 40, 50%, whatever we're generating in the fund, and if we just limit that to 6, and then put a governor on it, shut the cash flow off, and everything over and above it just gets reinvested, right? You get multiple uses of that capital, turn it over 2 or 3 times inside of a 10-year mark. Now you've got a nice piece on the back end, right? To deliver growth to the investor, and albeit in the structure, tax-free growth, right? So that is kind of a baseline of the actual structure and the why. I think what's been not just the figures, right? The predictability or the economics. What we've also really liked, or what our investors have loved, was the ability to strip out some of the biggest risk sets facing oil and gas, right? And so normally what this means is that our biggest risk is going to be price, right? If I'm producing, say, oil or gas or whatever, your economics are really live and die by the price of that commodity. Well, yes, but if you can hedge out enough production, right? If you can hedge out enough production to take most of that risk set off the table, right? Now you're in that business of that repeatability, right? So not just repeatability of are the wells getting the production we want, but also on price, right? So we use a combination here, but collars mostly, but the point ends up being the same, is that we want to hedge enough production so that if the market moves, if prices move against us, you still can go to investors and give them their initial dollar back, right? So we don't hedge everything, right? We want to participate on the upside, but you want protection on the downside, right? So that's really the baseline structure there of what we're trying to implement for investor protection mechanisms. And you guys know a lot of this stuff, right? You're getting Schedule K1s with these types of things. You'll know, or you would like to know if you're looking at these. We get ours, actually, our first batch of K1s are going out on Monday. We get ours out early to mid-March each year. I know that's a pain point for several of you that deal with these. But we also try to offer unique tax incentives or tax value adds, I should say, as well as some insights. So we work with a number of third-party CPA firms that will run a hypothetical, right? So give you the upright, so to speak. Here's where I live. Here's my numbers, blah, blah, blah. We can give you some tax analysis on that. And we also have different components that basically summarize. So if we get into the weeds on the tax code, we can show you a tax handbook that goes into it, right? So these aren't our interpretations of the tax law. They're all just coming from the tax law. So I wanted to stay in my lane here, Jimmy, in terms of time. You guys are running a tight ship, but I also wanted to give the ability to paint a picture on some of these, just a different slant on the industry and a different way to maybe access the space itself within opportunity zones.
Well, it's great. Always love hearing from you guys at USEDC. It's a much different strategy than a lot of other opportunity zone funds. I love our real estate sponsors. We got a lot of great development real estate partners on the show with us, but this one's a little bit different flavor, this oil and gas operation that you guys have allowed investment into here. Really clever strategy too, because a lot of these Permian Basin sites just happen to be they happen to fall into opportunity zones, as you mentioned.
Amazing.
We've got a few questions from the audience. I'll pose them to you now if you want to stick around for a couple more minutes here, Fred.
Absolutely.
Let's see. First question comes from Robert. He asks, how do you construe... Actually, he's got a series of questions here. We'll get this first one first. He says, how do you construe the annual 6% yield as tax-free? Or did I hear that wrong?
Yeah, no, you didn't. So in a normal occurrence, and I can send some offline info so we don't elongate, the Q&A part, but it's a very normal occurrence with oil and gas. Typically, if you, let's just say $1, you put $1 into the industry, you're getting a lot of upfront deductions, typically 80, 90 cents, right? That you can take as a 90 cent, 80 cent tax deduction, right? It's an above the line deduction on your taxes. So in other words, it offsets income. Now, the reason that we have it this way is that when you come into an op zone, if you have a gain of $1 and you put it in, the first day you're in, your outside basis is 0. So even though I've got a loss, I've got a 90-cent loss, a self-employment loss on that buck, I can't give it to you because you're at a 0 basis. But what I can do is basically hold it, right, in suspense, captive to the fund, so that in year 1 we pay 6, right? Now you've got 84. In year 2 we pay 6, you have 78. In year 3 pay 24. Right. So now you've got 24, right? It'll chew that up over time, but that's in general why.
Good. Second question from Robert. He says, how does one get a capital gain from this investment at the end? Do you put all your wells up for sale or what? And I guess a similar question. I asked this question of Matt a couple of years ago. I was like, I don't understand this. Like, aren't I investing in wells and don't they get depleted and the value of them actually goes down over time? But anyways, walk us through exactly what's the investment and what's the capital gain opportunity after 10 years.
Sure. Yeah, that's a really fair point. So the cool thing with op zones, even though we own mostly production like the wells that you're seeing here, it's all geographic, right? So a drilling fund has to own drilling wells, right? But these can own anything if the geography works. So you'll start to see us own some midstream assets and whatnot. That could work as well. But the point is this. Think of it like its own mini C corp, right? So U.S. Energy, we put about 120 million in last year of our free cash flow into these same assets. This year it's going to be 250, right? So what you're doing is you're limiting the amount. You're taking a little bit of that cash flow. In this case, the 6%, everything over and above, you're reinvesting. So basically, if we start with say 10 wells, right, and we have 150 wells in a single fund, right? We want diversity. These are how we kind of manufacture that outcome, right? We focus more on things like sigma and bell curves and trying to kind of hit in the middle of that. But the point is that if you start with say 10 wells and all of that cash flow is because they cash flow so fast, you'll end up with between 60 and 70, 80 wells over a decade's time just from reinvestment. So in other words, the first 10 that are in there, we'll sell those in year 10. You're not going to get much. You're going to get like 10 cents on the dollar. Why? Because you've depleted all those resources. But the value, right? The real that value creation there is coming from the wells that you acquired in years 4, years 7, years 9, because now you've got not just 5, 6, 7 times the assets, but they haven't produced anything yet. They've got all of their future cash flow left in front of them. And that's really where it comes from.
Yep. Great question. And then where does the gain come after 10 years? What's the exit strategy? I think is getting after Robert's question there.
Yeah. So that's just us. So PDP, proven developed production, trades on a daily basis, right? It's bought and sold daily between the majors, the institutional space. The reality of for us, we put a massive back end carrot for U.S. Energy. So it may or may not still be, but I know in the beginning this was the leanest op zone structure on the street. So I'm not going to say it still is because the space has evolved a lot, but everything's done at cost, right? There's a small fee annually for G&A, but it's basically done a cost plus 0, and it's all in the back end, right? So if the fund performs, we've got a big motivation on the back end because we get a big tax-free payout if the investor hits those preferred terms and those pref rates or those hurdles, which are pushing a 2x at this point before we can activate those fees. But it's all in the back end. But the short answer to your question is these things trade every day, right? People are buy and sell production and using calculations like PV10 to look at what those values are over time. But it's just that part of it.
Good. Let's see. Another question we got in here from Robert was, let's see, what happens if oil falls and settles around $50 per barrel due to global recession?
That's a huge point, which is why we do this, right? So what I would say, Robert, is if I was naked in the market, our break evens are about 50, 48, 50 in that range overall. If I was naked in the market, meaning that if you put a dollar in, you're going to get a dollar back out in a perfect world at $50 for 10 years, right? In a vacuum. Now let's go extreme. Let's say 50 became 40, became 30. If I was naked in the market, the short answer is your potential 3x would be a 1x, right? Or less, right? Now, because of that, this is why we do this, right? When we started working with the Chevrons, Exxons, and Oxys of the world about 5, 6 years ago, it not only gave us repeatable, predictable production, it also gave us this, right? So even though we've been doing this 40 years, we still weren't big enough to hedge production. The banks would look at you and say the counterparty risk to that is way too big. So we, by utilizing and working with the majors, we can do this. So because Exxon, Chevron, all these guys are behind it, now what we're doing is we have most of it's some swaps, but it's mostly collars the way we do it. So think of it this way. And these numbers are a little skewed. Right now, my collars aren't 72 by 84. They're closer to 64 by 76, I believe. So in other words, for about 50, 60% of the production, not all of it, because we want participation on the upside, but I only have to hedge half to protect your first dollar. So for that first half, if prices go above, say, the upper strike, 75, 80, it gets called away. If it goes below 64, it becomes a put, right? So you don't make or lose on the outside, and then it floats in the band for half. Then the other half we sell at whatever the current strip price is. And that's kind of that workaround there that gives us that ability to at least protect that first. And it's all about that kind of that Warren Buffett rule, right? Don't lose money. We wanted this to be in that driver's seat because capital preservation is really everything in these structures, but ours comes from hedging.
Very good. And then final question from Robert, and then we'll get on to somebody else. He wants to know where he can download this deck. And typically, I make decks for all or at least most of all of our presenters available on our website, usually by later today or tomorrow at ozpitchday.com. And I think you guys in the past have made this deck available for my audience. But Fred, I don't know if you want to chime in also.
Yeah, absolutely. And here's our contact info. If you want to send us an email, Robert, we can get that right over to you. Here, our public site, and if you check out our public site, and guys, even beyond the scope of structures, if you guys are just looking at the space, we have a bird's eye view as a fully integrated operator in the energy sector. We get a lot of questions on macro themes and trends. So we do have a lot of videos, podcast content, white papers, blah blah blah, that are on our website as well.
Good stuff. Another question came in from Tom. Tom asks, is this similar to how an MLP works from a tax perspective?
No, because these are a little bit different, right? So on the MLP structure, you're typically looking at, and sometimes you'll see them specific to say like a midstream assets, right? Like pipelines, or even royalties, or even the royalty trust vehicles, those public exchange vehicles in the market. Those are a little bit different. They're on a certain theme of that, and they're basically pass-throughs, right? So if it's a pipeline, it'll be this volumetric asset, kind of like a toll road that it will pass through that cash flow back to you, and you can kind of get in and out of those as an open end. These are a little different and they're closed. And then also an op zone, it's very different. But typically those are going to be locked into the mid and maybe sometimes the upstream. Not so much the down, right? The downstream are your refineries. Investors don't have access to that utility side. But these are very different. These are an LP structure at the end of the day, but not in the MLP or specifically the traded MLP world.
Good answer there. All right, we got a couple more questions here before I cut you loose, Fred. Thanks for sticking with us.
Of course.
Brad wants to know, and thanks, Brad. Brad's been an MVP today. He's stuck around for the whole thing, I think, or just about. He wants to know, hey, Fred, what are you raising funds for? What's your minimum investment? What's the waterfall of investor versus sponsor on their promote?
Yeah. Awesome question. Any well-structured product should have something that's investor first, right? If someone doesn't have the confidence or the balance sheet to give investors the lion's share of their revenue, that they're not going to be around in this business long term, right? And especially for us, right? Because we've been doing this a minute here. And 5 to 7 years ago, we had a whole different host of players. 5 years before that was a whole different host. And we've actually been fortunate to be in one. We've loved that the space has grown, right? Even love the competition, right? Because for them to take capital from us, they need to perform better than us. And we still have yet to see that happen. And I think it comes down to deal structure, and I think it comes down to access, right? So, but back to your point, and every fund's different, Robert. But basically, we've got an 8% hurdle rate or preferred return. So this fund itself, we take nothing. Now there's there's an AUM fee that will start at a point, cap out at like 1.75. Everything else is on the back end, but investors got to get close to a 2x before we activate anything beyond that. And I can send you a breakdown that are more specific on the structure. Everything you'll see from us will show unit shares or share prices of 100,000. We typically are a little flexible, agnostic with that. So if you have needs below, let us know. We can work with that. But that's typically what you're going to see from us. And again, in very different, we have 4 or 5 different fund styles, this being one example.
All right, $100,000 minimum investment, but a little flexibility there, it sounds like. I think you answered all of his questions. Thank you. This other question here just came in. Great question here. Regarding your QOF, how will the QOF determine the lower of deferred capital gain amount versus fair market value of the QOF investment for capital gain recognition in tax year 2026?
It's the best part, right? So, and going back, we were discounting different share classes for other things, right? We have this whole suite that does nothing but Roth conversions. It takes $1 in, it shows 50 cents. People convert to a Roth, wipes out half the tax. They love it. And we were looking, that's been going on for years. And that's a different fund. But my point is this, when we're looking at this, right? And if you actually look at section 1400 of the OpZone tax code, it doesn't say you're just going to take your dollar, right? So you bought NVIDIA for $1, you sold it for $2, right? You've got your gain, you put it in. It doesn't just say, put your dollar into a QOF and then pay your cap gain later. You know, it says that, but it says something else. And then something else is you can actually pay either your initial deferred gain or the fair market value by December of 2026. So here's where it gets tricky, right? And fun. It's kind of an opportunity in oil and gas. So let's just say you put $1 in and it's grown to $1.30, right? Whatever the number is. In oil and gas, you are required to heavily discount and suppress valuations. It's just the law, right? And so the actual term is a percentage of what's called PV10 or present value of future cash flows, right? It's kind of like how zero coupon bonds used to perform, right? Or even Ginnie Mae bonds, where it's like if Jimmy, you have this asset, it's going to cash flow $100 to you over the next, say, 4 or 5 years. What are you going to pay for that today? Well, what's my discount rate? Blah, blah, blah. The point is the answer is less than 100, right? What's that value? And that's kind of where we get this value from, is that we're required. So in oil and gas, your dollar typically shows up sometimes as low as 50 cents, sometimes maybe 60, 65 after the first year or two. But the cool thing for investors, you can just take and apply tax law. This is not this gray area or a listed, one of these areas that's questionable or the fringe of the tax code. It's literally in the tax code, and you can apply it, and your dollar is now 60 cents, 70 cents. And the way that we'll do this is, and we do this every year for these other strategies, but we'll post that value. And investors can either take a copy of the value, or they can actually use whatever custodian, Pershing, Schwab, NFS, whatever, these things are available. And you can house it there just to capture that lowered value and basically take a 30% basis step up, right? Because of that. So it's just a nice way to not just defer, but also reduce and then ultimately eliminate that gain.
And then maybe instead of paying capital gains in 2027 on that $1, maybe you're only paying on 70 cents. Is that right?
That's the whole point.
That's brilliant. That was a great question too, because that's a really subtle nuance of this whole thing that I can tell that person who asked it is a bit sophisticated when it comes to OZ investing. So great question there. Fred, I think we're out of time, and I think we're out of questions too. I think we got through everybody's questions. If you have any questions for Fred or his team, please do head to their website, usedc.com. You also had that email address up a moment ago, marketing@usedc.com. Fred, great to meet you, by the way. Thanks for joining today. Great hearing from you, and have a great rest of your day. Appreciate it.